and welcome. You're watching The Money Show. I'm Kavita Thapliyal, and once again, we are celebrating a very special week, and it's World Investor Week. You heard that right. World Investor Week 2025 is a global campaign being celebrated under the aegis of International Organization of Securities Commission and SEBI from October 6 to 12, 2025. Now, to raise awareness about the importance of investor education and investor protection, ET Now has always looked out for the investor, and keeping in line with the channel's ethos, we will be creating special programming for World Investor Week from 6 to 11th October. So all you have to do is just tune into the Money Show at 5 p.m. on ET Now every day, and especially this week because we'll be hearing from a lot of experts who will share actionable insights on how investors can better manage their personal finance portfolios. And we'll be bringing this special programming to you with our banking partner, State Bank of India. So let's begin, and today we'll be talking about very basics. In fact, we will take a step back to the very basics, understanding investment strategies across gold, equity, debt, and real estate. Now, in a world full of uncertainty, from rate pauses and inflation worries to market highs and commodity swings, one rule stands tall: diversification. But this big question is, how do you really strike the right balance between all these asset classes? Is gold still the ultimate safe haven? Are equities still the best wealth creators? Can debt make a comeback? And is real estate, or rather REITs, finally the stable income play investors should look at? Now, to break this all down and give us a ground level view across asset classes, joining me are some of India's finest market minds. I have Sunil Subramaniam, market expert; Devang Shah, head of fixed income Axis Mutual Fund; commodity expert G. Chandrasekhar; and Preeti Chheda, CFA REIT. Hello and welcome to this very interesting show. We are celebrating Investor Week the entire week on the Money Show as well. Let me begin with gold, because that's really shining high and making a new record every day almost. Chandrasekhar sir, gold and silver prices, are seeing or witnessing sharp moves globally as well as domestically. Now, let's talk about the fundamentals over here, and especially the kind of demand we are talking about from central banks and important triggers. Are we talking about gold and silver being the ultimate safe haven right now? They always had that appeal, but now has this gone up?
Well, gold has always been a safe haven, as all of us know. And this year, from the beginning of this year so far, it's gained well over 45% in terms of its price. And that's created a huge amount of bullish fervor. The charts also suggest that there is a further upside possible. Momentum, it's likely to breach $4,000 an ounce and possibly go to $4,100 or even $4,200 in the short term, because there are several factors that are driving this market. One, of course, as you rightly mentioned, global economic uncertainty, fear of slowdown, geopolitical risks, wars, Trump's tariffs, central bank buying, all of that. They all have combined to confirm the safe haven status of gold. As I said, charts are suggesting a small upside, further upside, but believe you me, I would actually caution investors at this point of time. The higher gold goes, the greater is the risk of a big correction. And therefore, it's extremely important for investors to stay glued to market developments and take a call when to exit. And it's extremely difficult. You should know when to exit. Entering is easy in the market, but the strategy lies in when to exit. And here is a time we are approaching, in my view, that it may be time for market participants who've gone long to exit. And particularly, I would think those who have invested in gold at, say, when the prices were below $3,500 an ounce, I think they should book their profit. It is my view. It's my personal call, but I must I must issue a disclaimer. I'm not a trader. I don't hold any trading position.
Let's move to debt now, fixed income. What kind of scenario, Devang, do you think is coming up for fixed income? If I have to take a cue from the international market and the Fed stance?
Thanks. So first of all, as you rightly highlighted, today is a time of complete uncertainty. I think tariffs and I think most of the panelists will also agree at this point of time, there is a lot of uncertainty in the market. Fixed income, therefore, makes a lot of sense. And from a macro perspective, I think RBI in the last couple of days back, last week, we had the monetary policy. And RBI was very, very clear that there is some space for easing and the inflation and growth dynamics, which has actually changed over the last, thanks to GST announcements, as well as overall, we are one of the highest tariff rate among the emerging market pack, as well as among developed markets. If I keep aside certain economies, we are at the one of the highest tariff rates, which will create some bit of, I would say, dampener for the growth cycle. And our view is that within macro dynamics, which is weakening growth, inflation, it would be lower by 50-70 basis thanks to the GST cut. It opens up some space of 25-50 basis of rate cuts for RBI. Also, as you highlighted, Fed has started to ease, and we have seen one rate cut. We might see a couple of more rate cuts in the next 3 months. And our perspective is that with Fed cutting, with the local dynamics being positive, I think there is room for easing on rates. And we believe there is a 20-25 basis of rally across the curve possible in the next few months. So we would advise clients to hold on to their fixed income bets at this point of time. Yes, it is at the last leg of rally because we don't expect significant rate cuts. But at this moment, in the market environment where Fed is easing, you have the weakness on growth and the fall in inflation, I would urge investors to continue to hold their bet on debt fixed income products and to hold on some duration at this point of time.
All right. We'll be coming back and talking about investment options also in fixed income. But then let's move towards equity. Sunil sir, the markets are really going up in the sense we can see a leadership rally that the market is trying to take, at least in India. Although FIIs are continuously selling, the numbers are coming down day by day, but I don't know how much that means. Maybe you'll have to decode that for us. And also now the consumption play is also in focus as per all experts, and everyone is just waiting for the consumption theme to really play out big time. We are also in a phase of earnings right now. What kind of the trajectory you think the market is into? What's driving the current trend? Where do you see sustainable growth from now on coming on?
Thanks, Kavita. That was a fairly long question. So give me a second to get my breath from your question. So first of all, so first thing is that I want to say on the equities asset class, because we heard about the fixed income and gold, is that equities is not a short-term asset class. You have to have a minimum 3 to 5 year outlook in doing anything in equities. So let's take that aside. So asking for a short-term view where the markets will be the year end, all of that, I think for an equity investor, if this was a trader, this is a different issue. But we are talking about the investor week for the world. So I think that you got to have a minimum, I would say, 5-year outlook to come. Now, with that 5-year outlook, you did mention that the markets are currently in a fairly consolidating phase, and you face that the FIIs have slowed down their redemptions, right? But the key element here is that you have to remember, and that's the continuing factor for the next 5 years, is that domestic support for the equity markets is only going to rise. In a 140 crore population, we have only 5.5 crore unique PANs in the mutual fund industry. Awareness is growing. AMFI has done a massive campaign called Mutual Fund Sahi Hai, and you're seeing the SIP grow month on month to now about 28,000 crores. I see this touching 50,000 crores and 1 lakh crores over the next 5 years. So domestic liquidity is going to support the equity markets. That's the first thing from a 5-year perspective to remember. Second is that while this is strong, this will not alone be enough for the market to reach a inflation beating return. We do need the FIIs to come back into our market. The reason is, despite all of their selling, they still own about 1/6 of our total market and 1/3 of our free float capital market. So they are not a light force to be ignored. So domestic can give support, but return of the FII is absolutely critical for a inflation beating return, which is what you expect from the equity markets. Now, why the FIIs have been selling? The answers are three there. One is that the India's promise of growth for the future. Our current growth of 6.5 to even 7% may be protected by all the defensive actions taken by the government. But for us to reach an 8, 9, 10% growth, we do need America to be a buyer for Indian products. The reason is that single-handedly they are 30% of the world's economy, right? So, and 40% of FII flows into India originate from America. So let's not discount the fact that tariffs are the most important thing. But apart from that, what the tariffs have done is to damage the long-term growth potential, and hence for FIIs who currently they are seeing there's a downside protection, but they don't see the upside. So when they are looking at it from a valuation perspective, they have found China, South Korea, other markets to be, though their growth rates are lesser than India, their valuations are far cheaper than India. So for FIIs to come back, two things need to happen. Those markets need to get more expensive. And second, we need to see some light at the end of the tariff tunnel. Undoubtedly. So in the short run, up to the next 2 years, I would say that the market will be in a consolidating with an upward bias, because as you saw, FII selling has come down. So they're also realizing that the Indian government has put all its efforts behind supporting the country in a time of tariff. So any downside risk on the Indian economy and the Indian markets, I think, has been taken care. The upside. Now, from an upside perspective, you asked me about the sectoral growth which will come through. So just before the Independence Day announcement by Mr. Modi, if you look at the consumption sector, it was the worst performing sector in the country over the last 1 year, 2 years, 3 years, 5 years, because the post-COVID recovery of the Indian economy was very polarized. Today, 10% of the population controls 60% of the national income, and the wealth dispersion is even more. 1% of the population controls 40% of the nation's wealth. So high-end products were selling in consumption, mass market products were not selling. With the masterstroke of the GST rationalization, which was preceded by RBI rate cuts and by the income tax relief that the budget announced, I think that consumption has now turned tables. Now the future is going to be about growth in consumption, have no doubt. So to me, for the next 3 to 5 years, consumption is a very strong rebound story, because it has to first catch up with the past underperformance, and then I believe it will also outperform the rest of the market. So number one pick from that is the consumption. The number two pick is that if you've got this 5-year outlook in mind, what the consumption is going to do is going to help. See, basically in the economy, there are three things that drive the GDP growth, which is government capital expenditure, building roads, airports, ports, and all that. Second is private consumption. Third is private capital expenditure. Private capital means expanding capacities for the current set of manufacturing plants. Because consumption had suffered, capacity had dropped, and it is stuck at 75-76% for quite a long time now. But the previous capex cycle started when capacity crossed the 80% mark between 2008, 9, 10, 11. So as the consumption now gets boosted, sometime in the next year, you will see that the capacity utilization will start shooting past 80%, and private capex cycle, which is a 3 to 5 year cycle when it starts, because multiple factories start expanding. So with a longer term outlook, I would believe that the overall capex story, which has cement in it, steel in it, engineering capital goods, EPC contractors, and all of them would be the beneficiaries. So I would say that allocating to the infra space broadly, especially industrials and engineering capex, would be the next wealth creation that will happen over the next 5 years. And supporting these two foundational pillars, consumption and capex, is the banking system. Because as I said, that India's growth ultimately has to be financed. And whether it's consumption through EMIs or it is through lending to the medium and small scale industries to fulfill the order books they get for private capex, banks have an absolutely important role to play. But when I say BFSI, it's not just about private sector banks, it's also about public sector banks, it's about NBFCs, and this is just the lending side. On the wealth creation side also, as per capita income grows, we are going to touch 3,000 probably sometime this year, but over the next 5 years, you think the 3,000 easily double to $5,500 to $6,000. So in that case, people don't spend all their incremental income, they also save. So the savings bucket is not just with current account and savings account and term deposit banks. It's about mutual funds and SIPs, it's about insurance, it's about these people entering the stock market through direct equities. So the entire BFSI space to me is poised for a massive kind of a bull run over the next 5 years.
Let's talk about REITs and Preeti. REITs have quietly become an interesting, alternative to physical real estate. Now, what should a first-time investor know before getting into this space? How do REITs score better on liquidity, transparency, and returns compared to traditional real estate investments?
Yeah, so we heard about fixed income, we heard about equity. So this is one instrument which is actually giving you the best of both worlds, which is giving you regular income as well as growth. Now, as a product, instead of actually taking exposure to a physical real estate asset, where you will have to worry about renting the asset, maintaining the asset. So instead of that, this is one instrument which actually gives you access to physical real assets, whether it's infra assets or real estate asset, without actually owning them. You can actually go ahead and buy even a single unit of a REIT or an InvIT, which will be like 500 rupees or below, and take exposure to pan-India real estate. So that's one advantage. Even when you talk about returns, this is one instrument. If you look at REITs alone in the last 5 years, they've given anywhere between 14 to 15% return for very moderate levels of risk. So from a risk return perspective as well, you are getting into a product which is far less volatile. In terms of return, it is anyway 14 to 15%, which is very attractive for this kind of a product. And obviously, because it's traded on stock exchanges, it's highly liquid. You can really buy or sell whenever you wish to. So I think this is one product which, of course, has become very popular amongst all investors, especially mutual funds. And as our panelist Sunil rightly said, today you see REITs sitting in almost every kind of mutual fund, be it equity, balance funds, thematic, and so on and so forth. And even in terms of investment by individuals, 5 years back, we started with some less than 10,000 investors. Today, we have about 3 lakh investors. Of course, that's also much smaller as compared to mutual fund. But I think gradually this is gaining enough popularity amongst all kinds of investors. And of course, from a tax perspective, also because dividends are not taxed in the hands of the unit holder, it makes it very tax efficient as well.
All right. I have actually shot up on my time limit as well, but then I really have to take one more round of questioning and we'll keep the answers really short. Chandrasekhar sir, let's talk about silver. What is your analysis saying in terms, it's doing better than gold apparently. So the prices would cool down?
Yes, not as rapidly as I anticipate for gold, because gold and silver both move in lockstep or in tandem. If and when correction in gold comes up, it'll obviously affect silver, but silver has its own trajectory. Remember, it's not just a precious metal, it is also an industrial metal, particularly in this era of energy transition. There's a huge amount of industrial application, electrical, electronic industry, photovoltaics, e-mobility, etc. And more important, last 5 years in a row, silver market is in a state of deficit. And this year, the deficit is 6,000 tons. And that's the reason why on the demand side, it's quite robust. Supply side, when there is a deficit, silver has reached the current levels, $47, which is the highest level since 2011. That's about 15-year high. And I can see a little more upside for silver. I believe there is every reason for it to cross $50 an ounce from the current level of just around $48, which currently the local price, our domestic price is about 1.5 lakh rupees a kilogram. And as silver keeps gaining, it'll get reflected in our domestic prices, because for both gold and silver, the price, we are not the price setters, although we may be large consumers. Prices are set in the international market in London and New York. We simply follow the international market, and therefore we are price takers. Our prices will reflect what happens in the international space. Therefore, silver
Right.
is a slightly better bet than gold in my view
All right.
because of its
All right. So talking about commodities,
industrial
you
nature.
can slightly invest more in silver because more upside is slightly more possible as far as silver trajectory is concerned. But then Devang, quickly, you were talking about investments can be made in fixed income right now. So what the duration that we are talking about? Can we lock in for a longer period of time? And what instruments are we also looking at?
So I think SEBI has come out with a very good category, and the tax bill gave a lot of further clarity last year for a category which is income plus arbitrage, which gives you probably a debt-like returns, and from a tax optimal and efficiency perspective, if the investment is hold for 2 years, it is taxed at 12.5%. We all know that all debt funds incrementally are at a marginal tax rate. So our view is that incrementally for all retail investors, when they're looking at any kind of debt allocation, at this point of time, they should be slightly on the higher side on the duration, which is around 3 to 5 year segment duration is what we like. The corporate bond segment is the segment from a fund category, which is generally preferred at this point of time, where you are in a cycle where you have limited rate cuts, easy banking liquidity, and we believe that the segment will perform very, very well. The category which investors should focus on is corporate debt, 3 to 5 year duration, and somewhere down the line, focus on this income plus arbitrage fund of fund category, which, as I told you, if the investor holds for 2 years, the taxation rate is 12.5, and which makes them a very, very tax optimal and efficient solution.
All right, let's talk about REITs and so what's the right way to invest in REITs? Preeti, if you could just help our viewers understand this. Should it be a lump sum investment? Can we do an SIP? With office space demand and rental improving post-COVID, what's the best time to invest in REITs? What should be your return expectations as well?
So I think I would say every time is the best time for REIT. At any point in time, you can pick up. And since the lot size is, as I said, just one unit, it is just about 500 rupees or thereabout investment. I think this is one investment you can do on a regular basis, whether you do through funds which are dedicated for REIT InvITs or have REIT InvITs within them, whether it's debt balanced. That can continue. And I think direct investment also is very easy in these products. And even if you see the way they have performed in the last 5 years, as I said, 14-15% is what we have given. But given the nature of these instruments, about 6-7% yield and a similar kind of growth is something which can be expected out of these instruments. And obviously, given the economic growth, you should see that translate into the growth of these products as well. As we go along. And another point which is important to note from a real estate perspective, if most of the REITs that you see are housing 50% of their portfolio by way of GCCs. Manufacturing demand is picking up, so therefore the demand for domestic tenants is also growing. And both of these should augur very well for REITs because they house a lot of these tenants.
All right. I think that will be all. So whether it's the shine of gold, the stability of debt, the growth of equities, or the steady income for real estate, the message is clear. Diversification is your best defense and your strongest strategy, no matter what the market throws at you. Staying balanced and informed will always keep your portfolio strong. And with that, thank you so much, all four of you, for taking time out and helping our viewers understand the current trend of each asset class. Thank you so much.
Thank you.
Time to sign off, and this was the Money Show, your guide to smarter investing during World Investor Week. Thank you so much for watching. Goodbye.